markets go up and down by the day, right? And we try to have a little bit of a more longer-termish view. The inflation pressures are not over and done with, right? So, there are clearly people are getting a little bit worried that the Fed may have raised rates at a very rapid speed for quite a few times. So there is a limit to the extent to which they will increase their rates. But we think that they will have to go quite a bit further, into next year.
What are you penciling in for the terminal rate now?
So somewhere between 4 and 5, but and so pretty close to what the markets are priced. So market expectations, if you look at what traders are betting their money on, right, that has come down a little bit, but not hugely, right? Okay. So we're still looking at 4.5, by the middle of next year.
All right.
Was the bond market drawing too much from Australia, the RBA going by 25 basis points and not by 50? Is that an idiosyncratic story that really governed that decision, and does it necessarily have a bearing on what the Fed could do in November?
I'm not sure that, I think it's definitely very interesting and important that we don't see all central banks just following the Fed, whatever the Fed does. I think it shows more that inflation is not as big a problem in many Asian economies as it is in the US. So in a way, the US may be a little bit the odd man out in the sense that we've also seen other central banks over here being much more modest, right? Even those that are increasing their interest rates.
So, but does it feel, if I may, does it feel like we have seen the peak in yields and the dollar lose?
That I don't think so, because the dollar will continue to be strong, and the external pressure on continents like APAC will continue as long as the Fed, is not finished with their hiking cycle.
So your space, the Asia Pacific, Louis, a couple of seconds ago you were saying that there's less inflation here, although there is inflation, than, let's say, in the U.S. So therefore there's less pressure to raise rates out here in the Asia Pacific versus the U.S. I mean, this cuts both ways in the sense that if that's the case, there will always be that yield differential to the U.S.'s advantage and could lead to money being sucked out of this part of the world to the U.S. where the returns are better. But the flip side is, of course, if there's less pressure to raise rates, there's also less pressure on growth out here.
That's right. So and that's what we're seeing, right? Yeah. So if our growth indicators over here, just also like the hard data, but also like surveys are still, not too bad. Yeah. And, I agree very much with how you put it, Martin, because we have weaker inflation. That means lower interest rates and lower expectations. It does mean, of course, pressure on the currencies, but in terms of what it means for the, for the real economy and for growth, it's not too bad.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.